So you've just asked a bunch of tough questions of your loan officer, and let's say you're comfortable now with giving them your business. Let's talk about some follow-up questions that you're going to want to ask them. This way you understand exactly what it is you're getting into with the biggest purchase of your life. Number one question is, let's say they are pre-qualifying you at $250,000 because that's the national average of a home purchase price. You're going to want to know what annual taxes they're basing that off of. And the reason why is because most buyers back into this transaction. They say, I can afford this much a month, and then they talk to a loan officer, and based on their past history, that qualifies them at this amount, right? And one of the biggest payments you're making in your monthly installments is your taxes. How do taxes differentiate from municipality to municipality or town to town? Let's just say that the town appraises your house out at $250,000. Now, the town wants to make sure they're going to tax you, right? They need to get paid, so they're going to want to make sure that you don't rebuttal them at the end of the year. So they're only going to tax you off of what's called the assessment value. The assessment value is 70% of the appraised value, or what they feel your fair market value is. Now, each town has what's called a mill rate, and the mill rate is what is multiplied by the assessed value in order to figure out your annual taxes. Now, hopefully by now, when you were speaking with the loan officer, you told them what towns you're interested in, and they have a fair idea of what the taxes are average in that town, or at least they can Google the mill rate and figure out, based on your pre-approval, this is what it is. Because I've seen a lot of borrowers go into this transaction, they get pre-approved at $250, we spend a lot of time looking around $250, or maybe I find a house for $275, negotiate it down to $245,000, we lock it in contract, we go back to the loan officer, only to tell them that your payments are higher than what you're comfortable with because of the taxes. The taxes are a big, big key part. So in order to avoid this whole thing, another follow-up question that you are going to ask of your loan officer, I'm pre-qualified at $250,000. Please give me a line item sheet as to what my payments will be like at $250,000, at $225,000, and at $200,000. Because think about it, when you're shopping for a home, you usually put in about a $50,000 range when looking for a home, and you want to know whereabouts your payments, or an estimate of what your payments are going to be when you're looking at these homes online or when you're walking through them. That way you can establish when you're walking through the home, well, I know based on what the loan officer has told me, this is what my payments were. Does this house strike an emotional chord, or do I see enough value in it to up my payments that amount? Am I comfortable with those payments? Now I get it. Mortgage calculator can do this for you, but however, mortgage calculators can also be wildly inaccurate because there are variables that are that do affect what your payments will be. And the only way to get a true feeling on the pulse is to speak with a professional. So those are follow-up questions. Make sure you follow up with those questions.